Hi, I can't keep up with this SPAC craze. I mean, today's news was that Chamath Palihapitiya invested in not one, but two different SPACs. It is a SPAC craze that's going on right now. Market is ebullient. People are pumped. One SPAC that he's investing in is Latch, or bringing Latch public, and the other is Sunlight Financial. This video is going to focus on Latch, and my next video will focus on Sunlight. Chamath previously described Latch as the best SaaS company he's ever seen or invested in. So that is high praise coming from him, as he's a venture investor that's looked across many dozens, if not hundreds, of investments. And based on my review of their metrics and their growth profile, he's not exaggerating. This is clearly an exceptional company with exceptional metrics. Currently, Latch trades through the SPAC TS Innovation, or TSIA stock, but in the future, if the deal goes through, it will be Latch Stock, or LTCH stock. So what is Latch Stock? Think of it as the operating system for a multi-unit apartment building, where, if you want to enable people to easily swipe into the building, let's say using their phone, or even to get into their apartments, or, someone's trying to buzz up, you can see on their phone there's an intercom feature. Oh, is that an Amazon delivery person, or is that an imposter? Oh, maybe you just want to set up the structure so that way your phone, your key cards can get you into the building, into your unit, but you have guests for maybe the housekeeper to come certain hours on certain days. And maybe the UPS person, can come, the USPS person can comes, only during certain hours and not on set days. So, it sort of creates a security system. You can track the cameras. The way, their description of an OS for the building, or Latch OS, I think is very fitting. The company has a wide range of possibilities in the future in terms of what's the stock potential. And I go into that full detail at the end of this video, where I'm penciling out several 100% upside if they deliver on management's expectations, whereas material downside, 70%, something like that downside, if they whiff or if valuation contracts. As I discuss in this video later on, while there's a lot to be excited about with Latch, where it seems like they have this unrivaled value proposition and they're tapping into this huge market, there's some aspects to this deal that rub me the wrong way. For example, the SPAC founder does have a lot of conflicting interests when it comes to this deal, where they're seeing it through the lens of not only the SPAC founder, where they're incentivized to get this deal done and get shares as sort of a payment. It's a nice return on getting a deal done. But they're not only the SPAC structure, but they're also a customer, one of their core customers of Latch, and they're also an early investor. So they're sort of switching, selling from one pocket to another, and they're telling you what's the fair value for something that they've already invested in. And so it makes me a little uneasy to think, well, what are the actual fair deal terms here? And I'd be curious to see how the market prices this over a multi-quarter, if not multi-year perspective, when all this information becomes much more transparent. Who owns it? What are the actual details behind the financials versus just a colorful presentation? I personally want to see a lot more information before I want to get involved. I want to see a detailed prospectus. I want to see a few quarters of execution. Management is penciling out this rapid reacceleration in growth in 2021, whereas in reality in 2020 they're penciling out a dramatic deceleration in revenue from over 100% growth to 20% growth in 2020. So I'd want to see that. I want to see why that's being delivered. I want to hear more about that. They really don't talk about that much in their comments. So let's dig into this. But first, a quick 10-second plug. Who am I? What are you watching? My name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. If you enjoy learning about potential multi-bagger stocks that can potentially go up hundreds or thousands of percent over time, make sure you subscribe. If you're already a subscriber, I really do appreciate that thumbs up. appreciate the work, like the detailed analysis. That thumbs up helps spread this video online. And if you want to follow my personal journey, what are the potential multi-baggers that I'm personally investing in? I give a monthly update along with a lot of other exclusive content that I'll talk more about at the end of this video. You go to unrivaledinvesting.com, click on Journey to find out the full details. Now let's do the full detailed deep dive into Latch based on the information that we know now. The deal was just announced earlier today. Let's dive right in. So as we look at the deal, you're looking at Tishman Speyer, which is a global leader in real estate, and so that's their first interest. Like, we need to understand what they are, and they're managing nearly 60 billion in global assets, 80 million square feet. This is a real estate company first and foremost, and they say leading global real estate company, and they're focused across the board. This isn't just owning things; it's acquisition, development, asset management, design and construction, equity and debt capital markets. So they're looking at the investments, leasing, portfolio management, property management. This is across the whole board. I mean, this is a global real estate empire. This is an empire in terms of real estate, and this SPAC is just one aspect of this empire, where this SPAC is an equity investment that they are making into the property technology space, and that's why it's TS Innovation. They were looking for some sort of innovative property-related technology company, and that's what they found with Latch. So first, understand, here it is, there's this global real estate empire, because this is really core to understanding what their growth potential could be and how there's a real pathway to rapid growth in the future. The deal terms were, right now that they say it's priced off $10. It's obviously a lot more than that now, as the stock prices jumped significantly. Also, keep in mind, a lot of people, going forward, honestly, people that are new to the game, new to the SPAC game, really don't understand how this works. But, you're looking at 156 million shares outstanding, 1.6 billion equity value. And so the share price needs to be multiplied by this to think about what's the actual value going forward. So whatever figure you're seeing in Yahoo Finance from here, it's not the real figure for what Latch will be worth post-closing. So you really need to be using this figure, and this figure is even a little low based on the footnotes. You need to factor in some warrants as well. So what's going on? You got 300 million in cash from the SPAC, as well as 190 million PIPE. Chamath is one of the investors here, and it's almost all going to the balance sheet, with the rest going to pay off fees. So it's not like you're having this huge payoff to existing shareholders or anything like that. It's going to the balance sheet to help accelerate growth, which is honestly, what I like to see. So what is Latch as we look at this? And, Latch, at the end of the day, management describes Latch really as an operating system that integrates third-party hardware with their software for the next generation of apartment building living. They started off, over here, and you can see sort of how it progresses over time, where it starts off with accessibility, using some sort of smartphone to easily access, go to your doors, quickly walk into either the building or your apartment. And then it's, access sharing, whether or not it's a doorman or package delivery or a housekeeper, something like that. Then you start getting integrated, and this is more of a recent development in 2020 of being directly plugged into your smart home, like your Google Nest thermostat. So that way, all from the same Latch app you can plug in. And then, here's an additional module that they've been selling in the last years, is intercom, where using the building's cameras, you can see who wants to come in. And then in the near-term roadmap, they make this, it's sort of footnoted, but you should know this isn't currently available, but it's something they want to offer in the future. And I think it fits hand in hand with what they want, which is with their path, which is additional services, like if you were to have something like laundry, where people were to come up and do your laundry, or maybe housekeeping, or renter's insurance, where they can work directly with someone like Lemonade to plug and play of like, hey, here's the policy detail. It's all in the same app that you're checking. You want your renter's insurance, boom, here it is. And then the next is maybe they get some sort of internet deal, all through the same app. You can see everything that's going on. So it strikes me as super interesting, as you see this. And, as you think about these, there's a key aspect to this, which is that this is going to be really, really sticky business. Like, just think about how difficult it'll be to swap out something like this. Like, once you're the hardware and software to a building where it's like, yeah, this is the software to let you in. This is the software on your phone to open your doors, or let in the Amazon delivery person. Like, this is not something that's easily swapped out. So that's going to make for a very sticky business. Means recurring revenue going forward, and we'll go through that split between hardware sales and software sales. But I think it's very fitting for them to use the OS analogy here, or the operating system analogy, because the OS, similar to thinking about iOS, where you have Apple's hardware combined with the software to make a seamless experience, that's what they're trying to do here, where it's this seamless experience all through their app. And it's integrating their physical hardware, so that way your living is that much better. You can just easily use your phone to get in and out. You're never having a locked out problem with your key, for example, or you're never having a rekeying experience if one neighbor loses their keys to the main entrance and everyone knows has to get a new key to the building. So you can understand that this becomes deeply ingrained, and it's not surprising when you see all these different aspects, like letting people in, using intercom, being able to potentially access your internet, or who are you letting into the building, or just going into your apartment, that the users that currently use the app are using it nearly 5 times a day. So people are very engaged once they're using it, which makes sense. You want to go in and out of your apartment. Now, do they have any real customers, or is this just sort of a pie in the sky concept? And the reality is they have some very real customers. They have some of the largest customers in the world, where you can see Brookfield or Fairfield Residential. I mean, these are some of the major players. And it says Latch is a diverse customer group ranging from the largest real estate companies in the world. They talk about Tishman, Speyer here, Toll Brothers, which is a home building company. So you can see a lot of these major logos, a lot of very beautiful properties. These are the major players. Some of the major players in the world, and you can see that they're operating throughout the United States. I mean, this isn't just a one-off project in one corner of the world. They're rapidly rolling out. Products are installed in 35 plus different states. And this is a key line here, from affordable housing in Baltimore. So it's not just luxury properties with the coolest stuff where they're looking to upsell. They're saying affordable housing in Baltimore, to historic buildings in Manhattan, to luxury towers in the Midwest. So they're covering the full landscape here, throughout the United States. I think this is really just saying this is the next sort of revolution in terms of how do people live in apartment buildings. And this is, thinking about this and these relationships critically, it's important to draw another, critical conclusion, is like, why is it so important to think about all these major customers that they have? And the reason why is that once you win one of these major developers, one of these real estate empires, is that if you make them happy, you not only get the recurring business from people accessing their apartments each year, but these empires oftentimes look to expand, acquire new assets, build new things. So then you'll become their go-to technology provider for future rollouts. So you get a steady base of business, recurring business from that software from existing projects. Then you overlay with these companies getting new projects, and they're like, what? Latch is the customer, is the partner that we're dealing with. So then that they effectively become your growth funnel. These customers that you've already landed, so you don't have to spend as much on sales and marketing because you're already working with them. So it's really critical in terms of thinking about future growth through these partners. And that's exactly, sort of what you're seeing or what they're penciling out for the future. Let me jump here. Where, they're saying because of these relationships, 1 in 10 new multifamily apartments in the US are built with Latch devices as of 2019. That's incredible. The idea that 1 in 10 have that, Latch devices where it can be plugged in. That's honestly, that figure just strikes me as breathtaking. Now, what I don't know about this is built with Latch devices. Does that mean the Latch OS is actually up and running with that? Or is that like this could be turned on? It's a switch that could be turned on if they wanted to. I presume the way they're spinning it makes me think it's with Latch already turned on, and it's for the new buildings that are coming online. Nearly 10% or over 10% have Latch built into them. And they're saying 7 in 10 of the National Multifamily Housing Council largest developers as customers. So this is what I was getting at of these are the big players that should be driving their growth, in the years ahead. And critically, this also drives this figure, which is if you're pleasing the customers, you are going to have really low churn. And this is the part that sort of blows my mind, where they say they've experienced zero churn since launching in 2017. So that means they haven't lost one customer. And 54% of their bookings expansion was from existing customers. So existing customers are saying, yes, we would like to book these additional products that you're offering, like intercom, like maybe these renters insurance in the future. And that's driving a huge surge in their growth. But this figure alone, this 100% gross revenue retention, i.e. zero churn, now I understand why Chamath was saying this is the best SaaS metrics he's ever seen. What I sort of counter with this is the question of like, well, as I'm looking at this, does this, is there the conflict that because some of these customers are also investors, has that sort of skewed the data historically, where if you were to have customers that weren't investors, would they be more open to churning? Now, I also suspect, to sort of ping pong on this analysis or thought process, is that once you're installed in a building, it's not like you're going to rip it out and say, okay, here, everyone, let's switch back to manual keys. It should be like, hey, this is it. This is a way of sort of upselling our building, making it a nicer building, a new experience, something that's seamless and just a beautiful experience. But it does make me wonder how true those metrics are. And part of the reason why, how come they're winning this business? And here's sort of the economics of how this works, where they're saying $7 to $12 per apartment per month is the current range for smart access, smart home, and guest management, plus 6-year average contract term. So this is how they think about the unit economics, or the charge per owner of the building. So they're charging on a per apartment per month basis. They'll oftentimes pay up front. But then you can see, why these buildings, will partner with them, where they're saying, look, there's this huge increase in revenue of up to $200 to $500 per apartment per year. So that should far outstrip, the investment here that they're making. And they're also reducing expenses. So, you have this, you're able to, let's say, rent it out for a higher price because it's this premium experience and positioning. You probably have, because people like it more, they're going to say decelerated turnover, so people stay longer. That might be phony baloney, but whatever. I mean, I could definitely make the case for premium experience, charging more, increased rent. It's sort of saying the same thing. Amenity fee upside, charging for the fees or whatever, and ancillary monetization opportunities. These are all sort of saying you're able to charge more for this. And then they're saying reducing expenses. One key one, is this idea of recurring rekeying expenses, which is this: if you're in a multi-unit building and someone loses their key and you want access, to the entrance, everyone in the building needs to get that new rekey. So there is this idea, like if you have a bad experience where you get locked out, or you have some sort of issue, or delivery management, someone's going into your building and stealing packages, it's probably a lot easier to manage those risks and those expenses with something like this. And so that's why they're saying not only do you get this revenue boost, but you also are potentially looking at lower expenses for the building as well, which is an interesting take. So what about competition? And it's interesting here that they're framing themselves. Latch OS is the first multifamily operating system that is able to service this opportunity and is defining the building operating system category. This is what I like to hear. This makes my ears tingle a little bit when you say you're defining a category. That means you're sort of setting yourself up. You're defining an industry. And when you're defining an industry, that is like the opposite of a commoditized industry where it's cutthroat. You don't really know how it's going to play out. Commoditized margins. And they go further. The way we sell our products is also unique, as we become essentially the trusted technology advisor for many of our customers. While traditionally this takes 8 or more disparate, largely disconnected vendors to replicate the capabilities of Latch OS, we're able to consolidate all of these capabilities in a single system, i.e., if you wanted to offer what they're currently offering, it would require you to use so many different vendors that they're making it so much easier by having it all in one operating system that helps you go in and out of your building, cameras, who are you letting in, who are you letting out, an intercom, and then eventually these other services as well. And so here they go. We are a SaaS business serving one of the world's largest industries with no direct competitors. This is what makes our business model and growth trajectory so unique. So when I hear something like that further, my ears are now getting really ringing, because, saying that we're not really seeing direct competitors, generally in the marketplace, they're taking these different vendors and trying to put it together, and that's obviously not going to work as smoothly as a Latch OS system. So this smells like an unrivaled opportunity. And as regular viewers know, I prefer looking at unrivaled setups, because that means you're not facing dramatic competition. If you're unrivaled, it means it gives you the right to capture share longer term. And so if you're able to capture share, your growth trajectory is going to be that much faster. So unrivaled, that's a really important one. Hearing that is a big thumbs up. I'm getting excited about this. Let's keep going. So then, do they have large potential? And they're saying, look, we have $54 billion annually in terms of the potential. They think that they've tapped into less than 1% so far. And by leveraging their relationships with Tishman Speyer, which is the core investor and an earlier investor as well, it could help accelerate their growth into other markets like Europe, where Tishman Speyer does have several properties, and so that could bump up their addressable market to 90 billion annual market opportunity. So you're looking at this huge, enormous opportunity, and you see the core categories of smart access, delivery and guest management, smart home and sensors, connectivity, resident experience. So you can see this whole thing where they're tapping into this just huge opportunity, and they have the correct relationships that should make it that much easier. And so, as I look at this, we'll do a quick recap of what we've sort of covered so far, and then go into the financials in terms of how we think about valuation. So you see this business that's extremely sticky, zero churn. You don't see SaaS businesses with zero churn. You see very low churn, but you don't see zero churn. So that's an exceptional metric. You don't know how much of that is just because of their investor versus customer base, but nevertheless. You also see a dramatic opportunity for upselling, where they say their net bookings expansion for 2020 was 154%. So 54% growth just based on their current customers booking these additional modules, like being able to buzz someone in and see the intercom. And I really do like hearing that they're defining this category. They're not seeing direct competition, and by and large, their value proposition is helping their customers take if they wanted to do this, it would require taking 8 different vendors versus having it all in one app. So that is really valuable. And I also really like the fact that their customers also become a core source, not only of business stability in terms of, you're going to get that software revenue year in, year out, but also a core source of growth as these same customers look to expand their real estate empire, buy new properties or build new properties, and then they're going to turn to Latch as the go-to for saying, hey, we want to be able to charge more for these future properties. We know this is defining the category where the end renter likes this experience. Let's use Latch, and that becomes, your future growth. So you have this platform plus future growth driven by their existing customers, and that should help accelerate their growth plans. Now the question is, what about their financials? As we look into this, and let's dig into these financials. So as we look at their financials, you see, and this is honestly, this part, in my opinion, strikes me as a little misleading, where they focus so much on this booked revenue, and I think they want you valuing the business off of booked revenue versus their net revenue figure, and it's dramatically different. I mean, it's between 10 and 20% the size, so it is a very sizable difference, and it honestly makes it way more complicated. But you can see, first let's just sort of walk through it, and then we'll talk about the differences here, where they're saying, look, we had booked revenue, and why don't they just call it bookings of in 2020 of 167 million, which was 49% growth year over year. And then they're looking to have pretty dramatic bookings growth in the years ahead, where they're effectively saying, hey, we think we can 10x their bookings over the next 5 years. So anytime you see 10x in 5 years, like, wow, that's incredible. And honestly, it just seems like all these SPACs that we keep coming across, management is just penciling out 10x, like it's as if it's just no sweat. Oh yeah, we'll just 10x over the next few years. That would be incredible if they can deliver on that. And you're gonna hear, you're hearing me saying if they can deliver on that, because that's gonna affect their valuation of if they can deliver on these figures. So you see this bookings, you can see the cumulative booked home units and how that grows over time from 304,000 to 3.7 million units around the world. Then you can see what the revenue is. Now, there are two key components here of hardware revenue versus software. And software, honestly, is really de minimis, a 4 million revenue software. So this is almost like you'd think this is almost like a micro cap territory. But, if this didn't have some of these famous names, if you were to show these financials to someone else and not tell them who's invested, and you're saying you have net revenue of 21% growth and 18 million in revenue, it wouldn't surprise me if you're looking at a company that would be valued at a micro cap level. You wouldn't be looking at a $1 billion plus valuation. You'd be looking at 300 million maybe. I could talk more about that later. For example, Journey subscribers know that, like, I think my December multi-bagger pick is a company with this level of revenue. Now, it doesn't have like 10x, or 50x potential like this, but it does trade closer to a microcap level at a much better valuation. Anywho, and they are projecting to grow at 10-20% a year. But here, looking at this business model, right now you're looking at negative gross margins for the hardware, where you see 14 million in revenue for the hardware versus 20 million in costs, and that's the way it's going to be pretty much for the next 2 years, where you're going to start making positive gross margin, in the years ahead. And honestly, that's a good investment to be making, just because it should result in really lucrative software. And that's what you see, where the software gross margin, 35 million in software revenue in 2022 versus 3 million software costs, that's a 90% plus gross margin. So that is supposed to be very lucrative. And then, you could see what they're penciling out for EBITDA, where, they're really not expecting to be profitable, or at least free cash flow positive, until 2023. But, I want to talk a little bit about this complexity that they're sort of driving here by splitting out this bookings and sort of saying, hey, this should be valued on bookings versus revenue in terms of how to think about this. And I think it makes it complicated, because bookings can occur for projects that are ultimately delivered up to like 24 months later. So the bookings you have here could really affect the revenue here. And it's always possible that, something falls out. Oh, you know what? We don't actually want that intercom module, so let's not get that. And so you're valuing a business for revenue that might not actually be delivered. And what's also very weird to me is that most of their software business, and they're showing that more than half of their bookings is software, most of their software business is actually paid up front. And that's what they say repeatedly throughout their presentation, where you have these software contracts where they're paid upfront for like a 6-year contract. Like, that said, that is so weird to pay a 6-year plus contract upfront. Like, I have no idea why these building owners would be willing, let's say, to pay $96 million upfront versus a much lower revenue figure, let's say 1/6 of that. If you were to pay it closer to a SaaS. So I suspect the reason why they're paying it up front is either, I would suspect it's because the building owners, like, maybe they're getting a really sweet discount off of what they would be paying on a monthly basis. And given that the building owners have historically been investors in Latch, that's the reason why you're getting this sweet deal. But otherwise, it just doesn't make sense. And it would surprise me if you continue to see that figure of, oh yeah, we have these 6-year contracts paid up front in the years ahead. The part that also confuses me about this is that if indeed we're supposed to be valuing this off of this booking segment, you see bookings of 167 million, and they're saying that the software part is, that is paid up front, then you should expect to see their free cash flow to be much higher than, let's say, their net income or their income statement reported profits. And EBITDA is something that's going to be on the income statement in terms of what's a sort of proxy for free cash flow. But the reality is, there's, you would expect, hey, if we indeed have these bookings and it's real cash in of, let's say, 160 million, then for the software, not even the hardware, which is going to get spread out, but software, even if it's, let's say, half of this amount, because it's spread out over 2 years and it's 80 million in actual cash revenue coming in versus their GAAP accepted, generally accepted accounting principle where you spread it out over 6 years of 11 million, 80 million versus 11 million, that would suggest this huge deferred revenue benefit of cash coming in. And you just don't see that because their EBITDA in 2021 is negative 88 and they're penciling out negative free cash flow of negative 76. So that's just like, it strikes me as really weird for them to say, hey, value this off of bookings, but the reality is that bookings isn't actually really there. It's not really like real cash coming in. So I honestly, I prefer, and I think it's more appropriate to value this ultimately on their net revenue until there's greater clarity on what is this actual figure, like, how does this actually tie to cash flows? Because you should be having, based on this, if this is a true bookings figure, you should have a much higher cash flow, free cash flow differential. And you do admittedly have that in later years, but even then it's not as dramatic as I would expect it to be. Here it is, 2024, 887 million in bookings versus 220 million in revenue. There should be this huge delta, 400 million plus of delta between EBITDA and free cash flow, and you're just not seeing it there. So that is weird. Plus, a big red flag and question mark for me is, like, your growth decelerated very dramatically from 2019 to 2020, where your revenue is only 21%. So why is it that you're penciling out this 21% and this dramatic acceleration, from 21% to 165%, going into the year ahead? So that's really weird. There's a lot of aspects of that I'd love to understand in greater detail. Also, in terms of their core metrics, they're saying their net revenue retention is 154% for their bookings. Their bookings, revenue retention, or this weird booked revenue retention, is 154%, and they had zero churn. So how is it possible that their year-over-year bookings is only 49%? I mean, it's relatively minor, 49 versus 54, but it's still weird to have that differential for your projections for 2020. Anyway, sure enough, 2020 will be probably coming out in the coming months, but it's just worth calling out that that's weird. This dramatic acceleration from 21% to 250, seems pretty, I'd love to hear a lot more clarity on why they think that's actually going to happen. But now let's actually go into their valuation. And so, as you look at this valuation, you could see currently around 15 bucks a share. This is the share count based on the presentation, the fully diluted share count. And that's what you need to use. If you're new to the investing game and you're using Yahoo Finance, good luck. You should always use source documents because Yahoo Finance is frequently wrong. So $2.4 billion market cap. I think it's more conservative to use the actual revenue, and I think it's probably more appropriate until we have a better handle on what's actual cash flow coming in, to use revenue versus bookings, this booked revenue. So revenue of 15 million, 18 million guided for 2020. And the high case, I'm using largely what management's targeting. You see the high case revenue of 877 million by 2025. And so that's what I'm saying of, hey, you have this incredible CAGR, you grow 165% from 18 million to 49 million, this next year. And then over the ensuing, 4 years from 2021 to 2025, you have, 105, 106% CAGR to get you to this 877 million in revenue. I mean, if that happens, then you should have a fantastic, one would expect you to have a fantastic return on your investment. But that really depends on management delivering on that. And, I wanted to do a wider range because what if growth is only 125% next year? What if it's only 100% next year? I haven't heard crystal clear why the business is going to accelerate so dramatically. I'm not saying that it won't happen. Don't get me wrong. Especially given the relationships they have, the investors they have, that are saying, hey, these are our properties. We want you to roll out into these properties and maybe we're going to upsell going forward. But I look at that and I just, 106% CAGR over 5 years is pretty darn high. And then, what's the optimized margin? This is a little trickier in terms of how to think about valuing it. Over by year 2025, they're saying still less than half their business, they're saying, is going to be software, where hardware is still the majority, and hardware is, keep in mind, super low margin. So that will hold back what their operating margins could be. So I'm doing a fairly wide range of 20 to 40% operating margins. The 40% is sort of people thinking, well, wait a second, you sort of have this annuity business in their software, and their software is 90% plus gross margins. That's going to be really profitable business. Whereas this 20% is this is going to be really really low margin hardware, and that's going to be the vast majority of their revenue for at least the next 5 years, the better part of this next decade. So maybe you should be valuing it, like this. It's a range. One could make the argument that I'm being too conservative, and maybe it should be 30 to 50%, just given the incredibly high margins that software has. Let's assume multiple 5 years from now. A lot of this, in all honesty, depends on how they execute. If they're executing and delivering on this growth, this 40 times might be low. Where if you're seeing 100% year-over-year growth, year after year after year, people are going to pay through the nose for this. In 40 times 5 years out, that's not crazy, in my opinion. Now, if they don't deliver, and you're not growing at 100% plus year after year, which honestly I'm skeptical of, how many companies actually deliver on that, especially when this year they're only growing at 20%. So when I see that, and you pencil out these lower figures, it's possible you get a much lower earnings multiple longer term. And I prefer to think about all these things as what's the sort of long-term margins for this business, slap on an earnings multiple, and that sort of gets you to how this business could be valued. And you can see this is a really wide range of 300% plus upside and down 70% plus. And honestly, this is part of my value proposition to you. It's a little bit cut off here, but I put this sheet available to you in the description of the video, where you can, you go to file, you go download the sheet, and then you can play around with the assumptions. So that way, if you disagree with any of the assumptions, or you think it should be higher or lower, you can easily do that. And that's what makes this pretty interesting in terms of this valuation sheet. Could I be, wrong about this? Of course. Could it go a lot higher? Could it go a lot lower? of course, right now we're in a very hyped market. I mean, as I mentioned at the beginning, Chamath invested in not one, but two different SPACs. Every day it's a new exciting SPAC, revolutionizing this industry, revolutionizing that industry, and so, you could have, just crazy valuation expansion. At the same time, if you have some sort of reality set in, you might have valuation compression. So we'll see how that sort of plays out. What are my sort of summary thoughts as I'm looking at Latch, thinking about this SPAC? And first of all, it's clearly a company with a lot of potential. Like, I see that it's incredibly sticky, and I see that there's this great growth runway. But there's also a lot of parts that bother me. For example, the building owners prepaying for the software up front. Like, usually the only incentive to do a huge lump sum deal, and they're saying like that's how the vast majority of our software is paid, is, the only reason why you would do that is if you were to get this huge sizable discount. And is that, are they getting this discount because Latch is both serving and owned by many of the same companies? Like, is there that sort of risk that I need to better understand? Another aspect is, another aspect that bothers me is sort of understanding the breakdown of who the current owners are. They don't really have that in the presentation, and they should have that in greater detail. Why not say, hey, these were some of the investors? I only found out by looking at the CEO and co-founder's profile that he led a Series B round that included, Brookfield and, Tishman Speyer. So, it bothers me that that's not sort of upfront. Like, oh yeah, there was this Series B round and they own stock in this, and their customers, and they're the ones effectively selling a stake to you. It does create this huge conflict of interest to have Tishman Speyer do this deal with the SPAC where they already own it. And like, what are they incentivized to do? Well, they're incentivized to do the deal first place because they're effectively getting a huge chunk of this company for free by doing the deal. And I'd say they have an incentive to get a higher valuation because then their private equity, investment, I'm sure they have some sort of private equity arm and, fund, is going to be able to say, hey, look at this fantastic return we've got. And now they can go raise more capital for their venture arm. And so that, that does make me a little concerned that you sort of have a prior investor telling you what the terms are that they're investing in with sort of others capital. Because if they're able to say, hey, this venture fund had just this incredible return, that would make it easier for them to raise even more capital in the future. So either way, Tishman Speyer wins. Look, they do have really, incredible financials, but, that no churn figure is incredible. But how much of that is because, the investors are also the customers? Will that change when you have this pure company where for sure, oh yeah, these customers have no equity interest in this business and they're truly sticking with them because they like the product. And it's a wide range of possibilities, where I say 70% on the downside, 300% plus on the upside. And that down 70%, like, that's not, my assumptions there weren't that, a conservative. I was saying like 25 times earnings 5 years from now, 20% margins for a business that's massively unprofitable now, and 50% plus CAGR over the next 5 years, where in the next year they're growing at 100%. So like, my assumptions in the low side were very reasonable in my opinion for if you wanted to have a wide range. So I think that's worth considering. As I look at them, I'm thinking, I'd love to see how they execute in the years ahead. Their revenue decelerated significantly in 2020. I want to see them deliver on that acceleration that they're talking about. And ultimately, I want to see, a prospectus for greater detail. Are they ultimately, hiding some things, that I wanted to learn more about. And with SPACs, sometimes, the upside to SPACs is that it's easier for the everyday investor to get involved. The downside is that it's a lot easier for companies with something shady about it to go public, and a lot of these investors don't find out about it until very last minute. We're like, oh yeah, here's the prospectus and we're voting on it. And it gets voted because it's already trading at 15 bucks a share versus 10 bucks, and people are like, yes, I made some money. And then months later, they're reading through the prospectus and they're like, holy smokes, look at these risks. So, as I look at this, it's not part of my journey, at least for now. I do like the prospect that they are unrivaled. It strikes me as an exceptional company. But honestly, I think I can find better risk reward elsewhere. Regular viewers know, Journey subscribers know that each month I call out a potential multi-bagger. And I think some of my recent, my December, January, and even February 2021 potential multi-bagger, I think has better risk reward than what I'm seeing, with here. Certainly my, several of these multi-baggers, I think have better risk reward than what you're looking at here, where you don't have to have these sort of Herculean assumptions of what it could do in the years ahead. And that's for those that are interested in following my journey. You know that I'm interested in trying to find these potential multi-baggers. If you want to follow my journey, what am I buying and selling, what I hold, each month I give an update of what's in my portfolio. I give interim updates for any sort of big changes in my portfolio. I have exclusive content, like an educational series on, how to think about, valuing companies, how to try to find potential, multi-baggers. I also have interim updates on, like, what do I think about the market? And, for example, if people are starting to get a little queasy about the market, hey, everything's so bubbly, what should you do about it? And, I recently did a post on that. And, if you're interested potentially, I'll have a link in the description of this video where it says, the catalog of content for the exclusive content. So you could see what you're getting yourself into, because that has a link to all the different exclusive links. And the reality is just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these potential multi-baggers, go to unrivaledinvesting.com, click on Journey. And if you enjoyed this video learning about Latch or TSIA stock, TS Innovation SPAC stock, make sure to subscribe if you're already a subscriber. I really do appreciate that thumbs up, and thank you so much for watching.